Welcome to the Greater Phoenix Economic Council's Inflation Reduction Act webinar. Thank you to our online viewers for taking the time to watch this briefing. This is an ongoing series of Inflation Reduction Act webinars to help you and your company to better understand and leverage this federal program. My name is Sean Fogarty, and I'm the Vice President of International Business Development for the Greater Phoenix Economic Council. On behalf of the 22 cities, Maricopa, and Pinal County governments, GPEC helps businesses that are considering investing or expanding operations in Greater Phoenix. In 2022, Congress passed and the President signed the Inflation Reduction Act into law, marking the most significant action Congress has taken on climate change in the nation's history. The Inflation Reduction Act, or IRA, comprises of grants, loans, rebates, incentives, and other investments. The IRA also includes some 24 tax provisions that will accelerate the deployment of clean energy, clean vehicles, clean buildings, and clean manufacturing. The Inflation Reduction Act includes several tax provisions and significant grant and loan programs to support deployment of commercially available and innovative clean energy technologies. These include the Clean Energy Production and Investment Tax Credits, the Production Tax Credit and Investment Tax Credit for renewable energy have helped drive deployment of wind farms and solar arrays in the United States. There is $40 billion in loan authority to guarantee loans for innovative clean energy projects, including renewable energy systems, carbon capture, nuclear energy, and critical minerals processing, manufacturing, and recycling. The Inflation Reduction Act includes several funding and tax programs to boost domestic manufacturing of clean energy technologies, including up to $250 billion in new loan authority for energy infrastructure reinvestment financing, extension and expansion of the Advanced Energy Project Credit, a new advanced manufacturing production credit. The Inflation Reduction Act includes a new production tax credit for domestic manufacturing of components along the supply chain for solar modules, wind turbines, battery cell modules, and critical minerals processing. The Inflation Reduction Act provides billions of dollars in consumer incentives to put more clean vehicles on the road and commits to making more of these vehicles and their components in the United States. Highlights include the Clean Vehicle Credit for consumers purchasing new qualifying clean vehicles, including battery electric, plug-in hybrid, or fuel cell electric vehicles. To qualify for the maximum $7,500 credit, the vehicle must meet certain standards for North American assembly. The battery's components must meet certain standards for manufacturing or assembly, and the battery's critical minerals must meet certain requirements for sourcing or processing in the United States or from trusted trade partners. Commercial clean vehicles credit can defray up to 30% of the cost of replacing diesel or gas-powered commercial vehicles with electric vehicles. There are 3 programs to grow the domestic supply chain for clean vehicles. The Inflation Reduction Act includes billions of dollars to support vehicle manufacturers looking to expand their domestic production of clean vehicles. There are many more programs in the Inflation Reduction Act, and we encourage companies to consult with professionals who can guide you through the federal programs. Today's webinar will run for approximately 1 hour. I need to highlight our disclaimer. The information provided on this webinar does not constitute legal advice. Instead, all information, content, and materials available on this webinar and website are for general informational purposes only. Viewers of this webinar should contact their attorney or qualified service providers to obtain advice with respect to the Inflation Reduction Act. Feel free to contact GPEC, and we'll be happy to connect you with qualified professionals. The views expressed are those of the individual speakers in their individual capacities. All liability with respect to actions taken or not taken based on the contents of this webinar are hereby expressly disclaimed. The content is provided as is. No representations are made that the content is error-free. Lastly, I encourage you to visit the GPEC Climate Tech webpage, which can be found on our website at www.gpec.org. Our presenter today is Marc Schultz. Marc is a partner with Snell and Wilmer, and his practice is concentrated in federal, local, and state taxation matters, including complex transactions involving corporations, limited liability companies, limited partnerships, tax-exempt entities, and real property. Marc regularly engages in advising clients with respect to mergers and acquisitions, joint ventures, formation of private investment funds, tax credit financing, and energy transactions. Marc currently chairs Snell and Wilmer's Tax Credit Finance Group and co-chairs Snell and Wilmer's Renewable Energy Group. Marc also founded and co-chairs the firm's Opportunity Zones and Funds Industry Group. Marc, the floor is yours.
Thank you, Sean, and thank you for everything that GPEC does. I really appreciate the invitation to speak to the audience about the Inflation Reduction Act. I'm going to speak about the transferability of these tax credits, and I'm going to go into structures and kind of what we're seeing in the industry with the Inflation Reduction Act as to the transferability of tax credits. So I'm going to share my screen. I've got about 26 slides, so some of them I'm going to fly through, some I'm going to spend more time on. Here's my contact information, and here's our getting started slide. So the Inflation Reduction Act, it passed back in, I think it was August of 22. It did a number of things in the renewable energy space when it comes to tax credit financing, which has been one of the major areas for financing renewable energy projects, as well as other types of energy technology projects, in addition to just renewable energy. But tax credit financing is a major component of one's capital stack when you're doing anything in the renewable energy space. Currently, we have an investment tax credit and a production tax credit. The investment tax credit is a tax credit that's based on a certain percentage of your overall investment to construct the project. The production tax credit is a tax credit that's generated based on performance of the project. So those are the two big credits that we see, or the mechanisms, either based on investment or performance. The Inflation Reduction Act creates these new carbon neutral credits that are going to take place for projects that are placed in service after this year. And so they're going to phase out the current investment tax credit and production tax credit. These are the new credits. They do apply to technologies where the facility generates 0 or less greenhouse emissions. We're waiting for regulations on how that's going to be determined. We'll probably see those a little bit later this year. Once we have these new tax credits, we have a fairly long runway with these credits, because they get phased out on the later of, and I know the slide doesn't say this, but it's a later of after 2032 for a 4-year phase out, or it's when the greenhouse gas emissions from electricity production in the US is reduced by 75% of the 2022 rates. So speaking with certain environmental attorneys, they have told me that could be 2040 before we see a phase out there. The other things that the Inflation Reduction Act did is it created a direct pay feature. So, currently, if you're a governmental entity or a tax-exempt organization, you don't qualify for tax credits. But this basically provides you with this ability to get a payment directly from the government if such governmental entity or tax-exempt entity wants to own a renewable energy facility directly. The other thing it did is it created a standalone battery storage credit, which is something we didn't have before. Before, you had to, if you had battery storage, a certain percentage, I forgot if it's 75 or 80% of it, had to be filled with renewable energy renewable energy electricity in order for the battery storage component to qualify for the credit as well. It expanded carbon sequestration, so it expanded what we call the 45Q credit, and it provided for credit for hydrogen production. So that's something that's brand new. But what we're going to talk about is transferability, and this is an exciting area, and you'll see why once I dig into some of these slides. Let's see. Let me just go into what is a tax credit. So a tax credit reduces your federal income tax liability dollar for dollar. So if I get $1 of tax credits, I pay $1 less of taxes. It is not the same thing as getting a depreciation deduction. If I get a depreciation deduction, I get to reduce my taxable income by the amount of the deduction, but then I need to apply that to the tax rate to figure out really what my benefit is. So if I'm paying tax at a 30% income tax rate and I'll get $1 of depreciation deductions, that's going to be worth 30 cents to me. These particular tax credits can only be used against a tax liability. It's not a refundable tax credit. Some states have what are called refundable tax credits, where it doesn't matter if you have a tax liability. If you don't have a tax liability, they send you a check. That's not the case with these particular tax credits. The one thing that the Inflation Reduction Act did was, if I don't have enough tax liability in a given year to use these tax credits, I can go back 3 years and apply those credits to tax liabilities I had previously. That is allowable, but not if my limitation and the reason I can't use my tax credits is because of something called the passive activity rules, and I'll get into that. Also, what the Inflation Reduction Act did was it allows you to carry forward the tax credits 22 years. There is a limitation that folks should be aware of, and that is you cannot use these tax credits to reduce your tax liability by more than 75% of what you have in a given year. So there is this threshold. You're still going to have to pay tax on at least 25% of your tax liability. There are a bunch of limitations that folks are going to need to be aware of. One, which I mentioned, is the passive activity credit rules. There's also alternative minimum tax, things like that that folks need to be aware of when you're acquiring tax credits. Let's see, slide forward here. So again, I mentioned the production tax credit. That is something that's based over a 10-year period. It's performance of the asset over 10 years, and it's based on a certain amount per kilowatt hour that's generated. So currently, it is 55 cents per kilowatt hour for most technologies, except for it is reduced for those 3 technologies you see on the screen there. The investment tax credit is based on the investment, so the income tax basis of the asset itself. So it's the equipment. So if I'm building a solar project, what am I paying for the panels, the racking, the inverters? That is the eligible equipment there. And so it's based on the purchase price I pay for that. And it's a certain percentage. This does not seem like it's these are great numbers, 6% and 55 cents per kilowatt hour. But as my law professors would say, keep reading. So I'm going to go to the next page. But wait, before I go to the next page, the investment tax credit is you get the entire investment tax credit in the year that you place the equipment in service. So that's usually when you get your interconnection with the utility, or you get what's called permission to operate. And then you get the credits all in that year. There's a 5-year recapture period, so you have to stay in compliance for 5 years after you're placed in service. I said that these numbers aren't that impressive, but once you see this, you'll see where I'm heading. And that is, there is a preference with the Inflation Reduction Act towards domestic labor, domestic production, domestic content. I'll get into all of this, but one of the requirements to get a higher amount of credits, which is a 5 times multiplier to the numbers you see on this previous screen. So that takes the investment tax credit to 30%, and that is if you pay prevailing wages and you satisfy the apprenticeship requirements. I'm not going to get into what all that means, but the bottom line here is if you satisfy these requirements, then you get a 5 times multiplier, which would take your production tax credit this year to $2.75. And we'll find out it's inflation adjusted. So in June, we'll see what that number is. Presumably will be a little bit higher. There is a preference of smaller projects, so you don't have to satisfy what we call PWA if the project has a maximum net output of 1 megawatt. Or if the project started construction, and there's different ways to meet this commence construction requirement. One could be based on how much you have spent, and then the other is starting physical construction. But if you did that before January 29, 2023, then you don't have to meet the PWA requirements. There are other goodies here called adders. I'm going to jump ahead a few slides here. Just because it just makes more sense to talk about it in the same context as the PWA. And that is, this will increase the amount of the credit. So like if you're looking at the investment tax credit, you satisfy PWA. If your project comprises of a certain percentage of domestic equipment and domestic steel, et cetera, you can add another 10% to your tax credit. So you're looking at a 40% investment tax credit. You can add 10% to the PTC as well. And the other two adders, one is for energy communities. So this is something that was placed in the Inflation Reduction Act to benefit projects that are located in communities that have or have had coal-fired facilities or coal mines and other fossil fuel industries that storage, extraction, processing, et cetera, that have to do with the fossil fuel industry, such as oil and natural gas, et cetera. The last adder that can get you almost up to 20% in certain circumstances, and that is projects that are located in communities that have been impacted by the fossil fuel industry. So the low-income community adder, that's only by application. It's fairly competitive based on data that we've seen for applications that have been recently filed. But if you add this all up and you're looking at an investment tax credit deal, you're looking at, potentially getting 50 to 60%, 50 to 60% tax credit. And then again, it's the same percentage on the off of the PTC rate as well. So let me just step back. I'm going to go through these slides fairly quickly. This is the credits that apply for ITCs. I'm just going to point out a couple or point them out again, and that is the energy storage that can be a standalone tax credit on the ITC. It is not available on the PTC, just the ITC. And then I want to point out that you have this other category here of these three: interconnection property, biogas conversion property, and microgrid controller property. On the PTC side, I'll point out that solar can qualify for a PTC So if you have a project that mostly you'd probably see in a utility scale project where the costs are less, but the output is great, you may want to choose to get the PTC over the 10 years rather than the ITCs. And then again, I want to point out this hydrogen production tax credit. So this is something that is brand new, and a lot of people are very excited about this. But I'm not going to go into any detail on this because I'm just dealing with the transferability of these tax credits. So let me go down a few slides here. So what has happened with the Inflation Reduction Act is we have 11 credits that qualify to be transferred. So here is a list. I'll point out this credit right here. This is for this right here is for EV vehicle charging facilities. So that's a credit that's available. It's a 30% investment tax credit that can be transferred. Some of the other credits here, the advanced manufacturing production tax credit, those are for production for facilities here in the US that are producing renewable energy equipment. Again, that is a production tax credit that can be transferred. So it's pretty exciting. We've got these 11 credits that can be transferred. The data on how big this industry is or could be, something I recently read was before the Inflation Reduction Act, they were looking at the amount of credits that would be generated to be monetized from 2023 to 2031 was somewhere around 70 billion total. But they are projecting, because of the Inflation Reduction Act and these 11 credits that can be transferred, that the capacity could be 280 billion over that same time period. So that is pretty significant, a pretty significant amount of potential credits to be transferred. We have transferability of tax credits. That's terrific. It has not really impacted what we traditionally were doing beforehand, which was traditional tax equity, where you have an investor that will become a member of your entity that owns the renewable energy equipment, which is usually some type of pass-through entity such as a LLC. They would get a K-1. They would be allocated the tax credits. They would stay in the deal for 5 years, and then you'll have a call option to purchase them out. It was called a partnership flip. We're still seeing many of those deals, and we're seeing deals that now combine transferability with your traditional tax equity called the T-flip, which I'll go into as well. Transferability has made it easier to combine incentives. Again, one of the areas that I do a lot in, and that is the opportunity zone incentive, which allows you to hold something for 10 years and then dispose of it or cash out on a tax-free basis. That can be used fairly easily with the transferability of tax credits. A lot of it had to do with trying to combine opportunity zones with your traditional tax equity investments were difficult because your traditional tax equity investor tended to be a large financial institution, which is not the same investor that usually invests in the opportunity zone incentive, which is high net worth individuals. Now with transferability, you can have individuals invest in a renewable energy facility, transfer the tax credits in exchange for cash, hold the investment, use that cash to either pay down debt or make a distribution to the investors, hold the investment, sell the investment after 10 years. It's usually not going to be an appreciating asset. It's going to be a depreciating asset. But usually when you sell any type of renewable energy project, you're going to have what's called depreciation recapture, which is tax at ordinary income tax rates. But if you use the opportunity zone incentive, there will be no tax to be paid on disposition. So it works fairly well. We're seeing a lot of deals combining those two incentives. So I'm going to move on. Who are the folks that can transfer these tax credits? It's pretty much anyone except for what's listed below, which are tax-exempt entities, governmental entities. We see a lot of deals where you have a limited liability company owned by multiple members. That LLC owns the project, and that LLC is the one that's going to transfer these tax credits. I'm going to move down here to how do you transfer the tax credits? Well, it's an election that is made. So it's an election that's made. It basically gets made on the tax return for the year that the credit is determined. It's made on a tax return. It cannot be made on an amended tax return. So if you are going to file your tax return and not file it on time, you're going to lose your ability to transfer the tax credits. You can transfer, you can have a renewable energy facility that generates a bunch of tax credits, and you can transfer those tax credits to multiple folks. So I have $1 million of tax credits. I can transfer, $600,000 to Sean. I can transfer $400,000 to someone else. So you can make multiple transfers with one renewable energy facility. There's something called a transfer election statement. That is something that requires a lot of information. It gets included on your tax return, and when we're negotiating transfer agreements these days, it's actually an exhibit on the transfer agreement that everybody agrees to, and that's what you're going to put on your tax return. One thing is that these transfers can only be made to unrelated persons. So relatedness is based on a 50%, more than 50%. If you're related, if you have more than 50% overlapping ownership between the transferor of the credits and the transferee of the tax credits. And you look through indirectly to who owns these two entities. You look through or you attribute related family members. So I will own what my brother I will be considered to own what my brother owns. So ultimately, the buyer of the tax credit has to be unrelated. The 50% threshold is fairly high for what we see in the tax code. So I haven't had too many transactions where I've had to worry about this, but it's just something folks should know. You have to register your renewable energy project in order to transfer the tax credits. And this was something that took the IRS, a lot of the delay in being able to transfer tax credits was the IRS putting together a portal. And a lot of it was to prevent fraud and duplication. So you basically once you've gotten to your permission to operate your project, you're going to apply for a registration number. There's a bunch of information that you're going to need and have to submit on the IRS portal, and then the IRS will give you a registration number, and that's something you're going to include on your tax return, both the buyer and the seller. And again, this was put in place really to prevent fraud. The service was very concerned about fraud in the sale of tax credits. So this is one of the safeguards that they put in place. So one of the requirements is that these tax credits can only be transferred in exchange for cash. So, it could be a money order, cashier's check, it could be a cash wire transfer, but ultimately I cannot take a piece of property and, piece of real estate and exchange that as a buyer of tax credits with the renewable energy project owner in exchange for their credits. So it has to be a cash transaction, and the payment there's a limit on when the payment can be made. So basically, that limitation is you look at the year that the project is placed in service. So if a project is placed in service this summer, and I place the project in service in, let's say, June of 2024, I could have received payment in exchange for the credits as of January 2024. But I can also receive payment up to the date that the tax return is filed for 2024, including extensions. So I would have until September of next year, arguably, to transfer those tax credits. After that date, those credits are no longer transferable. So I have this window where the transfer has to take place, or the payment has to take place. And so that requires bridge financing. So whenever you're going to build any type of renewable energy facility, you need the money. You need the money as soon as you start construction, even before, for pre-development. And so all these deals require some type of bridge financing arrangement, usually some type of debt financing that will be sought early on. You can have a commitment to purchase the credits in advance of the transfer of the credits, as long as the payments are made. The payments in accordance with the commitment agreement are going to be made within that time frame of the second bullet point there. So the transferee taxpayer. So again, we discussed that they cannot be a related party, so they have to be unrelated. One of the things that came out in the regulations, and just take a step back, we have proposed regs on transferability. We're expecting the proposed regs to be finalized relatively soon, probably in the next few months. But right now we're operating under these proposed regs, which are pretty extensive, with the preamble and the regs themselves. I think it's about 100 pages. But one of the things that it did provide in the proposed regs is that if I buy these credits for 90 cents and I exchange them, or I claim them on my tax return for $1, that's a 10% spread. I'm not going to get taxed because I have that spread. I paid less than what claiming the credits for. So there were folks that were worried about this when we did not have the proposed regs, but that question now has been settled. You cannot retransfer the tax credits. So you can you can be a broker of tax credits, where you facilitate a buyer and a seller, but you cannot take possession of those tax credits. You cannot take ownership of those credits and then transfer those credits. So we see a lot of deals, and there are a lot of brokers involved in this industry right now, but they're just, making a commission on the transaction. They're not taking ownership of the tax credits. So it's a one-time sale. And, I mentioned, I buy credits for 90 cents and I claim them for $1. That's a pretty tight spread. We're seeing anything from 85 cents to 92, 93 cents. So if all I'm doing, I'm not taking any depreciation deductions, I'm not getting any cash flow, I'm merely buying a tax credit and claiming a tax credit. I'm going to want certainty that I'm going to get that tax credit. So a lot of deals, the buyers are requiring tax opinions. There's a whole tax insurance industry out there, because you've got adders, you've got prevailing wage requirements. If those requirements are not met, then you're not getting the credits that you think you're buying. So again, folks are requiring the attorneys to write tax opinions, and in a lot of deals, they're requiring folks to go out and procure tax insurance. And there are quite a few players in the tax insurance market here. I just want to note that, PTCs have when it comes to recapture, it's not really a big issue with PTCs as it is with ITCs, because, ITCs, it's, based on how much you're paying, or how much your income tax basis is. And, that's something that there's some risk that I'm going to talk about there. But it's with ITCs, you can also have recapture if the owner of the project sells the project or stops using the project. And if you're a buyer of tax credits, that's a big issue, because you're not getting a K-1. You are separated from the project itself, because all you're doing is buying the credits. And so if the owner of the project decides they're going to transfer that project to someone else, that will cause a recapture. It's going to cause a recapture on the buyer. So there is a different risk profile in purchasing a PTC than an ITC. Just a little bit about about a transferee taxpayer. They can be pass-through entities, so you can have a limited liability company with a bunch of members that LLC goes and purchases tax credits and then allocates those tax credits to their members. So you can't have a retransfer of tax credits, but the allocation of tax credits by the transferee LLC is not considered a retransfer. So that is permitted. When you purchase these tax credits, there's something called the passive activity rules that you have to become acquainted with. And this is basically a rule that says that, and it applies to losses as well as credits, unless you're a widely held C corporation. So if you're a widely held C corporation, that's not what's called a personal service corporation, you are not subject to these passive activity rules, whether credits or losses. But everybody else is subject to these rules. And it basically, what these rules were put in place in the 80s, they were concerned about high net worth individuals that invested in transactions just to generate losses and then use those losses to wipe out their income. So like if you were a physician and you invested in a particular transaction, a lot of them were movie shelters. So folks would invest in movies. They might invest 100,000, but they get hundreds of thousands of losses, and they would use those losses to wipe out their practicing medicine income. So unless you're a widely held C corporation, if you invest in a trade or business and you get a loss from that trade or business or a credit, you can only use that loss or credit against your passive income or passive tax liability. So you're not a physician that invests in a solar project is not going to be able to use those credits against their practicing medicine tax liability. So one of the requirements to be subject to one of the requirements is it has to be a trade or business. So a lot of folks, when these rules came, when the Inflation Reduction Act came out, they said, oh, well, it doesn't really mention anything about the passive activity rules. And if I just go merely buy a tax credit, I'm not in the tax credit is not a trade or business by owning the tax credit, just an investment. So I shouldn't be subject to the passive activity rules. And that made a lot of sense. But in the proposed regs, the IRS said, nope, you go and buy a tax credit, one of these transfer tax credits, we're going to deem you to be in a trade or business by owning the tax credit. And we're not going to allow you to use that, which means you're going to be subject to the passive activity credit rules. And then we're not going to allow you to use the grouping rules. And this is getting very technical, but there are all these rules that say you can group activities together. And let me step back. If I'm a physician and I invest in a solar deal, I'm a passive investor in that solar deal unless I meet the material participant rules. And one of the rules to become a material participant and make that activity active instead of passive is to spend more than 500 hours in that activity. So I can't use this grouping rule that says you take a bunch of activities that don't meet the hours requirement, you group them together, you say they're all related, and thereby I have met the hours requirement. So I've met the 500 hours rule. I group it together and I say, okay, well, we're over 500 hours, so this is all active. And so I'm going to use the credits against my practicing medicine tax liability. You can't do that. And there's some other requirements too. I said 500 hours, but there's ways to meet it at 200 hours, but I'm not going to go into that detail. There is an exception that folks should be aware of, and that is if you're a closely held C corporation. There is an exception that allows a closely held C corporation to use a passive activity credit against an active tax liability, but it's only applicable for closely held C corporations. But that is an interesting area, and that's an area that we see folks like that or a lot of those folks are looking at purchasing tax credits because they can use those credits against their active tax liability. And then I've already said something on pricing. You know, again, you're just buying a credit and claiming a credit. So a lot of it is what you're going to pay for that credit is going to depend on risk. Again, there's no depreciation deductions for purchasing a tax credit. It's merely cash for credits. So I'm going to try to speed up the pace a little bit here. The payments itself, so when I go and sell these tax credits, it's tax exempt income to me. So it's not included in gross income when I go and sell tax credits. So if you're the eligible taxpayer, you own the renewable energy facility, you sell the credits, you're going to get the cash. You're not going to have to pay federal income tax on that cash. Although you have to look at the states and see whether the states are going to respect that same treatment. Right now, the thought process is in California, that's not the case. So the state of California, they decide at the end of the year which provisions of the federal income tax code they're going to adopt. And so we don't know what they're going to do for 2024, for example, but that's something to take into account. As the payor purchasing the tax credits, you don't get a deduction for purchasing the tax credits. So no income for receiving cash for the tax credits, but no deduction for the transferee taxpayer for paying for those tax credits. So because of this, the Treasury Department put in place some anti-abuse rules. I'm just going to go into, just to kind of give you the flavor for what they are concerned about. Let's see, I'm going to go to an example here. So example number one, taxpayer owns a renewable energy facility. They're in the consulting business, and they also, let's just say they put a solar facility on their headquarters. They have a bunch of $100 in tax credits that they generated, but they have a bunch of net operating losses. So they're going to just sell those tax credits to someone. And they have a customer that normally pays them $20 for the services. And the consulting firm that owns a renewable energy facility says, okay, I'm going to sell you the tax credits, but I'll sell you the tax credits for $20. Okay. So I'm going to sell you the tax credit. Normally I would sell them to someone for $80. They get $100 of tax credits, but I'm going to give you this discount. So you only have to pay me $20 for those tax credits. Now I have a bunch of net operating losses. I'm sorry. I'm gonna sell you the services for $80. I'm sorry. Thinking about the other example. I'm going to sell you the services for $80. So I'm going to charge you more for the services. I have a bunch of net operating losses, so I don't have to pay tax on that $80 anyways. You'll get a deduction. Had you paid me $80 for the tax credits, you don't get a deduction. But instead, I'm going to overcharge the services. You get a deduction. I have NOLs. And so the IRS was very concerned about folks doing this and kind of recharacterizing what you pay for the credits, because one person, isn't going to get a deduction for buying the credit, so they'll pay for something else that's deductible. And so the IRS has the ability to recharacterize those transactions. So instead of saying, okay, we're going to overcharge you for the services at $80 and you get a deduction, the IRS can recharacterize that and mark it down to $20, but then mark up the credits to $80. So these are just things to think about when you have a buyer of tax credits that also has a relationship with the owner of the tax credits outside of just purchasing tax credits. So I've got a couple examples on the slide here that are in the regs, but I'm not going to go into both of them, but you guys can get you guys get the gist of what the IRS is concerned about here. So another limitation that folks have to be concerned about are called the at-risk rules. And like the passive loss rules, widely held C corporations are not impacted by at-risk rules, but everybody else is. And basically what the at-risk rules say is, and this only applies to the investment tax credit, Congress didn't like the fact that money that was being used to construct the facility, it's coming from two sources, but they don't like the second source. The first source is equity. So tax credit investor puts in equity into the transaction that's used to construct the facility. That's okay. But if it's debt financing, and it's debt financing where the members of the LLC are not on the hook for the debt financing, so it's non-recourse financing. The IRS, Congress basically says in that case that we're going to mark down the credits to the extent that there is non-qualified, non-recourse financing. That's the term. And so we're going to mark down the credits to the extent that you use non-qualified, non-recourse financing. And so that's a big issue for the buyer of the tax credits, because without getting information, they don't have any visibility as to how the project is being financed and whether there's non-qualified, non-recourse financing. So if they're paying for credits and then it's determined that the at-risk rules apply here and reduce the amount of credits, and they obviously are paying for credits that they're not going to get. There are a number of exceptions that apply here. There's one particular exception that we use a lot, and it's for renewable energy transactions. So there are basically, as long as the non-qualified, non-recourse financing is not more than 80% of your 80%, and there's an exception at 75%. As long as it's not more than that of your capital stack, then you're probably going to fall within one of the exceptions. But just something to point out here. And when you're selling the credits, these are questions that are going to be asked by the buyers. Is the impact on whether Section 49 is going to impact the amount of credits that are generated. There is another limitation, and that is when you have a pass-through entity that owns a renewable energy facility, to the extent that you have tax-exempt organizations, foreign persons, and there's some exceptions here that apply, but also governmental organizations that are in the ownership chain of a pass-through entity, that will reduce the amount of the tax credit base in determining the amount of tax credits. And you basically look at the life of the project, and you look at, okay, well, you've got these members, and maybe they own a few percent early on, but they may own 60% later on. You look at the highest percentage interest over the life of the project that's attainable. And so in those cases, that can result in especially if you've got someone who's got just a few percent early on, but in years 7 or 8, just the way the allocations work, they're going to get a much higher percentage. That will chop down the credits by that higher percentage. So when you do these deals, there's always reps and warranties where you're pretty much forced to send someone a org chart so you can determine whether you have any of these disqualified persons in the organization structure, because that can impact the credits that are generated as well. So speaking of too much in tax credits, there's a term called excess credit transfers. And to the extent that a buyer of tax credits enters into an excess credit transfer transaction, they're going to get hit with an increase in their income tax. So an excess credit transfer, and this is all based on structure. So if your structure is done correctly in the beginning, you're probably not going to have to worry about this if you're a transferee of tax credits, but there are a lot of things you got to worry about. A lot of things you're going to have to address in the due diligence process. But basically, if you pay for a certain amount of tax credits and you claim those credits and they exceed the amount of tax credits that were allowable from the beginning, then you're going to get hit with an excess credit transfer transaction, which results in an increase in your income tax. So basically, the increase in your income tax is the amount of the excess credit transfer, and then 20% of that amount. And that 20% provision is something that is only to the, can be waived to the extent that reasonable cause exists. So basically, it requires the transferee taxpayer to engage in due diligence efforts on the transaction. And if you can show enough due diligence, then you can probably avoid that 20% tax on the amount of the excess credit transfer. And again, we only have an hour, so I'm not going into the details of what you exactly need, but just some highlights. When it comes to adders, you're going to need to kind of see how they determine the adders. Did you look on a map to see it's in an energy community, stuff like that. I'll get into like where you would need an appraisal, a cost segregation study, but these are all things that you're going to want to take a look at if you're buying tax credits, because that can provide you this reasonable cause exception. A little bit more about excess credit transfers. So, if multiple taxpayers, the transferee taxpayers are buying the tax credits and there's an excess credit transfer, it will hit everyone. There's something called the T-flip structure I mentioned before. That actually minimizes the excess credit transfer for the transferees of the tax credits. And just to give you a little highlight on T-flips. So a T-flip is your traditional tax equity structure where some of the credits are going to get allocated to the tax equity investor who's getting a K-1, who is a member of the LLC, and then the other portion of the tax credits are being transferred to a third party. And so the way it works is, let's just say I have a T-flip structure, and let's just say I have a tax equity investor that is looking to be allocated $250,000 of tax credits. I'm generating $1 million of tax credits, and I'm selling $750,000 to a transferee taxpayer. So I'm allocating $250,000, selling $750,000, and then the IRS comes in and says, "Hey, you got the adder wrong. It should not have applied. And so you thought you had $1 million of tax credits. You only have $800,000 of tax credits." Well, the transferee would still get their $750,000, but there would be $200,000 less tax credits to allocate. So it's quite interesting with these T-flip structures because it does provide a transferee taxpayer. It does help minimize the risk that they're taking on by purchasing these tax credits. And so here just below are some examples of things that happen that result in excess credit transfers. And that is, the at-risk rules that I went through before are structured wrong. You had too much debt, and that chopped down the tax credit. That will result in an excess credit transfer. You didn't qualify for an adder like you thought, or you didn't qualify for the PWA, or your income tax basis on the equipment wasn't correct. And I'm going to get into these basis step-up issues. They're quite interesting. We see that as a hot topic. So I'll get into that in a few slides. There is a concept called recapture. It's different than an excess credit transfer. Recapture occurs after you've placed in service the project. And so recapture will occur if you, and again, this is in the ITC area, so it really should say recapture, ITC recapture. But this is if the owner of the project sells the project or stops using the project. So let's just say you're buying credits and it's, let's just say you're buying credits from a manufacturing facility that put a solar project on top of their, did a rooftop project, generated some credits and sold you the credits. And let's just say that they have new management and that management doesn't want to use the solar. We're within the 5-year recapture period. We're in year 3. And let's just say for whatever reason, new management doesn't want to use the solar facility on the roof and they rather buy all their electricity from the utility. So they just stop using it. So that right there can generate a recapture for the buyer of the tax credits, just not using the facility. And so that's obviously a risk that they take on. And so they price in that risk, the buyer of the tax credits. And one thing about recapture is you vest. So if you're generating $1 million of tax credits and you're worried about recapture, well, you can only recapture every year that goes on, you can only recapture 20% less than what you started with. So if you start off with $1 million after year 1, it's only $800,000 that can be recaptured. The next year it's $600,000. So as time goes on, there's less credits to recapture. There are times, one other major item to talk about here is with respect to recapture for a buyer of tax credits, and that is the project level debt. So if the owner of the project is taking a direct loan and there's a foreclosure on the project, that does generate an ITC recapture. It doesn't generate a PTC recapture, but it does generate an ITC recapture. So normally you have to have the lender enter into what's called a forbearance agreement, which basically says that they're not going to foreclose on the project during those 5 years. And so that's why you tend to see in the solar lending industry a lot of the same usual suspects, because they've been able to get comfortable with the asset class and enter into these forbearance agreements. You see a lot of deals that are called back levered, so it's not a direct loan directly to the owner of the project, but it's a loan to the sponsor who takes those loan proceeds and contributes those loan proceeds as a capital contribution to the project, to the project owner. So there's no foreclosure on the asset itself. It's a foreclosure on the membership interest that the sponsor owns. And just to go through, there are some recapture risks that don't impact the transferee taxpayer. And that is, let's just say you're the member of the LLC that owns the project that sold the credit. They don't let you, the IRS doesn't let you just transfer your membership interest. They want everybody in for 5 years. So if I go and transfer my membership interest, I'm going to generate a recapture on myself, but it's not going to impact the transferee of the transferee of the tax credits. So that's something that will impact it. Actually, it's a change of ownership by more than 1/3. So there's a trap for the unwary here. So if you bring in during the 5-year recapture period, you bring in a new owner of the project, a new member that comes in and makes a cash infusion and thereby reduces everybody's interest by more than 1/3, that can cause a recapture on these other folks. It won't cause a recapture on the transferee of the tax credit, so that's good. And then if there's changes to the at-risk amounts after the place in service date, that impacts the current members that own the project, that own the project entity that owns the project, but not the transferee taxpayer. So that's it on recapture. I'm just going to just have a few more slides. I'm going to talk a little bit about your typical structure that you see, and just kind of explain how a T-flip would work. So here's your typical structure. I've got my sponsor owner. I've got an investor that comes in. This could be a tax equity investor that's in to get allocated tax credits. They get allocated 99% of the tax credits. They own a 99% profit interest in profits. Sponsor starts off with 1%. After 5 years, the recapture period, this is called a partnership flip. The sponsor will have 95% of the profits, and the investor will have 5%. And then the sponsor will have an option to purchase the investor's interest at fair market value, but it's fair market value of a 5% interest. That's what you typically saw in partnership flip tax equity deals. Now that we have this transferability feature, you technically don't need to have this investor, but when you have a T-flip, you still have the investor that stays in the deal. They get allocated some of the credits. The rest of the credits are sold to a tax credit buyer. But we're seeing deals right now where it's just the sponsor and, some of the founders of the sponsors, they go in, they own the project. They don't have a third-party investor, and they're just going to sell the tax credits to a third-party tax credit buyer. And then they're going to use the cash from that sale to either make a distribution to themselves or pay down some of the financing. So that's what you're seeing. It's a more simplified structure. Of course, the T-flip is not simplified at all, but your traditional or your not doing this T-flip investor and just selling the credits is definitely a more simplified structure. Next slide here is this basis step-up issue, and let me give you some framework behind it. A lot of times we have vertically integrated clients. They construct or they develop solar, but they're also going to hold the asset or be part of the team that's going to hold the asset in the long term and sell off the electricity. So a lot of these, especially in Arizona, a lot of these sponsors who construct the project, they're licensed, they have a construction license, but they don't want to hold the project in the same entity as the entity that holds the construction license. Plus, their bankers don't want that. They want a special purpose entity to own the project. And just from a liability perspective, you want a separate entity that's going to hold the project. So you'll have a transaction between this entity here and then this entity here that's solely in existence to hold the project and sell the electricity and then operate and maintain the project. So you have this transaction between these two. And, this entity here, they pay third parties for costs for the panels and for the inverters, for the racking. And they may hire what's called an EPC, which stands for Engineering, Procurement, and Construction Contractor, almost like a GC. So they'll hire that person to build the project, but then they're going to charge something. Oftentimes they want to charge a higher price to the project entity who's purchasing the project. And so that's called a basis step up, and you get the ITCs based on the price or the tax basis that the project entity is paying for the project. So oftentimes that's a higher price than what the EPC or developer here incurred in constructing the project. And that's usually done, that transaction takes place before place, and it's going to take place before place in service, usually at mechanical completion. Well, the IRS doesn't like that transaction. They don't like the basis step up. They just want to pay for third-party costs. And so they see these two entities as being related. And then, there's different ways that they've attacked these transactions. And when you transfer the tax credits to a transferee, they're the ones taking on this risk because the IRS can come in and say, yeah, you paid $2 a watt to build the project. You sold it for $3 a watt. we're not going to respect the $3 a watt purchase price because the sponsor was also one of the owners of the project entity that purchased the project. And so we see that as a related party. So we're going to write down the cost here to $2, and we're only going to give you tax credits on $2. Well, that affects the transferee taxpayer who purchased the tax credits. So that's something that they may want to get insurance on. They may want a tax opinion. They're going to want ways to reduce their risk here. And so there have been a number of cases in this particular space. And a lot of it stems from the American Recovery and Reinvestment Act. So that was put in place in 2008, 9, and 10. If you remember the Great Recession, a lot of the big banks who are the typical tax equity investors, for one thing, they're not subject to the passive loss rules and the at-risk rules because they're all widely held C corporations. And so they're your traditional tax equity investors. And so they were sitting on net operating losses. So they didn't need tax credits back in those days. So the government put in place this section 1603 of the ERA legislation that provided the owners of the projects with a cash grant in lieu of the tax credits. And so there were a number of transactions that involved this step up in basis, and where the purchase price paid here was a higher amount than it cost to construct the project. And so the government refused to pay on that basis step up. And so a lot of these cases went to court, and they're still being litigated all these years later. But again, this is a risk that the transferee taxpayer is taking on. So there's ways to minimize. Well, the first question you ask is, well, what is a related party sale? Do you have to have, does the sponsor team, in order for it to be a related party, is it more than 20%? Is it more than 50%? Is it more than 80%? And there's no magic. You ask 10 different tax attorneys, you get 10 different answers. So, but there is some relatedness between these two entities that's going to create these additional questions. And so how do you minimize the issue? Folks go and get appraisals. They try to limit the amount of the markup to something that's more reasonable. Maybe it's 10 to 15% markup. They try to show that they've got real third-party economic investors here who are evaluating the cost of the equipment and the revenue that the equipment's going to generate over the life of the power purchase agreement, which may be 25 years. And so these folks are in it for the long term. That's very helpful to be able to show that the price paid is fair market value, because this person here is in it for the economics. They're not in it for the tax credits, or in it for the economics here. So that's one way that's helpful. And then the second line of attack that we've seen is, in a lot of these deals, it's not just the sale of the equipment, but it's also a sale of the revenue contract, the power revenue contract, the PPA. And so the IRS has attacked that and said, okay, well, you paid $1 million. How much did you allocate to the power purchase agreement? Oh, zero. You should have allocated something. And by the way, whatever you allocate, or whatever we allocate to the power purchase agreement, which is a revenue contract, that doesn't qualify for the ITC. It's really the hard equipment and the labor for that equipment that qualifies. So that's another line of attack that the IRS has tried. And so oftentimes, putting in some type of reasonable allocation also helps on this issue. So this is a big issue. It's a big issue that folks are asking for tax insurance on, and they're asking for tax opinions. And again, it's a transferee taxpayer when it comes to these transferability transactions that's taking on the risk. So that was my last slide. So I am available for any questions. Folks want to call me, my contact information is at the beginning of these slides. And I'm happy to assist folks with any questions that they may have.
Well, thank you, Mark, for that very comprehensive and insightful presentation. As we wrap up, I'd like to ask if you have any final closing remarks before we end this program.
Well, transferability is it's exciting. I mean, it's opening up. What it's providing is tax equity. Is the fees are expensive. The lawyer's fees are expensive. Accounting fees are expensive to do a tax equity transaction. So if you have a smaller project, it's hard to do tax equity with smaller projects. With transferability, it has simplified things somewhat, but the whole purpose of it and the purpose of some of these adders and the preference of the smaller projects will hopefully allow folks that have these smaller projects to monetize the tax credits without having to go through a complicated tax equity transaction. So it's pretty exciting. Again, this market is huge. 70 billion was projected over what 8-9 years, and with initially before the Inflation Reduction Act, now they're saying 280 billion. So these are exciting times, and it's exciting for Arizona because we do a lot of solar transactions and other renewable energy transactions, and this can help you with your financing to get your deals done.
Well, thank you again for your presentation. Hopefully, this webinar will spark an interest among our viewers to learn more about the Inflation Reduction Act and how their company can and should leverage all these different programs, tax credits, incentives, and grants. So please contact GPEC if you have any questions or need introductions to service providers. GPEC service is free of charge. If your company or client is exploring setting up or expanding operations, don't hesitate to contact GPEC. We'll be happy to assist with your site selection and due diligence. I want to very quickly share my screen and just show you our Climate Tech webpage. So I would encourage you to go to GPEC, and we have a Climate Tech webpage where you can view more information about the Climate Tech resources and links to the videos. So we encourage you to reach out and contact us. Finally, thank you, Mark, for sharing your insights on the Inflation Reduction Act. We appreciate the support from Snell and Wilmer, and we would like to thank all our viewers for joining us. We hope you found the presentation useful, informative, and valuable. So this concludes our program. Thank you.
Thank you.